Within this video, I'm going to be giving an update on the FTSE 100, the FTSE All Share, the economics that are happening behind the scenes and what this could mean for the FTSE's performance overall. And I'll also be looking at the following year and where I think that's likely to head. So jumping straight in with the FTSE 100s, I've just outlined on this graph the significant support zones and the overhang and resistance that we're currently battling against. So you can see since the corona crash we've been in this sort of rally phase, this strong upward trend, and we've had this large overhead hanging resistance as well as this horizontal resistance here. And what we can see is at the start of the year, so this blue line marks the start of the year, we had a strong rally, and then since May we've basically been going sideways. We had a lot of confluence here with these two resistance lines, and then likewise we had confluence here with these two support lines. And I think this could act as a springboard to take us up to here for the end of the year. But I'll get into that. So currently we're in this period of consolidation, and I just want to go through why I think this has occurred and what's going on in the background. There's been a lot of talk recently about inflation, and we've seen it within the raw material prices of the likes of timber, natural gas, iron. There's been steel shortages, and there's been a lot of price increases across the commodity markets. So if I look in the UK, I'm just using this website, Trading Economics. You can see that over the last year we had fairly low inflation rates at the very start of the year, but since then they've significantly increased. If you look at here, we're at 0.7 and now we're up at 3.2. So it's gone up nearly 400%, the inflation rate. If we look on a longer time frame, over the last 10 years, you can see we were back down to these low levels in around about 2015, which we were at mid-2020. And then we had a rise over 2017 up to that peak. If you look at the rate of the incline now, it's significant. It's not really comparable. And what that does is it stirs the markets and it creates uncertainty. Are we going to have a runaway inflationary environment? Will the banks step in and control inflation? I mean, one thing you do see, if you have an increase in inflation, you get an increase in interest rates. I won't go into too much detail as to why, but effectively, if you think a loan's been made in this period, inflation rate's low, interest rates are low, you've made a loan in that period, you've still got the same amount of money that's outstanding, but now you're going to get a lesser return over here when all of a sudden the prices go up and you have an opportunity cost where effectively that interest or that capital is now worth less than it was back then. And that's all that inflation is. It is showing what is the value of money. Is the value of that money increasing or decreasing? So in this inflationary period now, that loan back then will be worth a lot less currently than what it was. And the way that banks recoup that is they increase the interest rates to ensure that they have adequate income to cover that. So that's kind of a brief explanation as to why, if inflation increases, interest rates increase. If interest rates increase, it's obviously more expensive to borrow money. It's obviously then encourages people to save money, which means there's less money going into the markets, into the economy, which then slows everything down, and then that's when you get this sort of slowdown in inflation. So that's a common economic tool that the likes of the Bank of England, the Federal Reserve can use to control inflation. Obviously the markets get twitchy if you do increase the interest rates. People then can't borrow, the likes of say Tesla, the likes of NEO, these sort of high-tech companies that have large liabilities on their balance sheet all of a sudden become a lot more expensive, and then obviously there's uncertainty on their future, and you get a lot with the growth stocks, and then all of a sudden sentiment changes and people start to view the future as being bleaker than what it once was viewed as. And that's a sort of summary around what can happen. It's just what decision the Bank of England decides to make. So in this environment then, we've got an increase in inflation. What sectors benefit from this increase? I just want to look at this graph from Schroders. So if we're in a high inflation environment, i.e. plus 3%, which we currently are, so we're 3.2. If we look at this graph, it just basically shows which sectors perform, so i.e. this top half beat the market, they've got a return. You're better invested in them than holding cash. And then along the x-axis here, we've got probability. The probability of us beating inflation. So it's quite an interesting graph. It's nearly 50 years of data. It's based in the US, but it's still comparable to the UK. And what's interesting is it lines up exactly as you'd expect. You've got precious materials, so that's where you're at the very start of the chain. Obviously, they can pass on all of their increases in labour costs, fuel costs, next down to the chain, and then it gets passed on eventually to the consumer. So it's easy for raw materials, for anyone abstracting or producing raw materials, to pass that cost on. It's difficult for the middlemen to then pass it down the line, and eventually for the retailer to pass it on to the consumer. How can they pass on that price increase and still get the same demand for the products? And that's why you've got metals and precious materials up there. Likewise with energy. Obviously energy, it's a commodity similar to precious metals, and that all of a sudden becomes more expensive with inflation. So equity REITs, so this is basically real estate investment trusts. So you have trusts that will go out there and they'll buy large commercial buildings, and then what they'll effectively do is look for rental income. Obviously, with an inflation environment, the rent increases and the actual building appreciates in value. So they're going to benefit a lot from an inflationary environment. So there's some ideas to look at if we do continue to have inflation. Is we want to be looking at commodities and we want to look at real estate. So moving back to the FTSE and just looking at where we're currently at. Obviously we're 3/4 of the way through the year. We've got 3 months left, and I'm saying that although we're entering an inflation environment, I'm expecting us to finish here at 7,400. And then this is where you sort of contradict yourself and say, well, why am I expecting us to finish higher in the year if I think inflation's flaring up, if I think it's going to become that environment of higher uncertainty? And this is where we have to look at seasonality. So the FTSE All Share over the last 20 years, you can see that seasonality, we start the year at zero, we take a dip in January, we have an explosive rally all the way through to May, and then we dip over the summer months, and then we have this well-renowned Santa rally at the end of the year. So if I compare that to the FTSE All Share, we can see here that it's an exact like for like. So in January we dipped, explosive rally. Summer months we took a dip at the start in June, July. We went back up, went sideways, we took a dip in September, and now we're at this pivotal point what I'm watching really closely over the next month is, will we see this Santa rally, this explosion of 4.5%, or will we keel over and will inflation win the battle with the stock market? I'm at a crossroad, so I think on that model with seasonality, because we've followed it so well, I think there'll be a Santa rally. I think there will still be a lot of money on the sidelines that's going to go into the markets in a final push to what's known as a blow off top, and I think we'll basically break out of this resistance, and in the new year we'll come down and we'll start back testing and breaking supports as inflation does eventually win. Obviously at the minute, if we're entering that inflation environment but there's money still going into the markets, it's not going to show the true underlying picture of the economics. So what I want to look at next is, okay, we've finished the year now, inflation's starting to heat up. What could be expected for 2022? So if I go back to the charts, and if I just scroll up to the very top here, we need to look at sector rotation. Obviously we had the corona crash in March, and then we've been in this long strong bull market, and now we look like we're topping out. You can see there that resistance, we're starting to top. We might have a blow off up to this level for the end of the year, but then after that I'm expecting us to pull back and start breaking down. So if this does happen and we have reached this market top, we're then going to start looking at the bear market and where do we want to enter. And again, this is where energy crops up. So once again, it lines up with an inflationary environment that we're seeing taking place over the last 3 months. We've got that high inflation environment. We need to be looking at energy. In a bear market, we want to be looking at energy really and looking around basic materials that's linked to that high inflation environment. And this is I'm sort of feeling at the minute we're here and we're just looking over the cliff and we're thinking, right, I've got a little bit higher to climb, but next year I can see is really going into a bear market and dropping down. In terms of the economy, we're only in these early stages of recovery. Obviously this year we've still had lockdowns and there's still wider economic issues at play. I don't think we've really recovered in the economy yet, but the stock market is always ahead. It's always predictive in nature. So for the following year, I think we're going to see a decrease, and we need to rotate more into these commodities such as energy and materials. So two stocks that I'm currently looking at to buy for this end of year rally and to protect me from any inflationary decreases is an iron ore producer called Ferrexpo. So you can see they had a large rally and they've had this double top and now they've come back down, and we can see here they're gaining relative strength and they're gaining momentum, and it's entered this zone here. So you can see we had a break, we had consolidation and it accelerated up. We're entering this zone of high activity, this really strong support level, and I'm drawn to this gap we've got here. So any gaps in the market means you've got trapped sellers here, and I really think that we're going to have a sharp increase over the next 3 to 4 months back to this level. So that's my first tip. An iron ore miner, Ferrexpo, I think they're going to benefit from a technical point of view. Fundamentally, they're going to benefit from a higher inflation environment. My second one, which is a very similar chart, is a platinum miner in Africa. So again, strong increase with the prices of platinum, and then they've fallen back recently. But what they've done here is they've formed a very strong base. So I've used the Fibonacci retracement levels here, and they're right on the 0.5 level, and you can see here strong touch points. And if I look at the resistance on the 1 hour chart, so we can just see it started back here, touch points, touch points, touch points, broke out, back tested, and what I want to see now is that this relative strength increase is going to propel the stock higher. So what I've seen, resistance points been broken, we're sitting above it, rising strength, rising momentum. I want to see a pushback at least to this red line here, which would be 24%, and again it protects you from that inflationary environment. So they're my two tips for the next, over the next, from now to the next 12 months. It offers inflationary protection, and still they're stocks that have large opportunity for a very good bounce going into the final part of this year. Thank you for watching.